Okay, welcome everybody to Finance 443, Week 2. Welcome to Salinas. Am I saying your name right? I hope so. Michelle, Jack, welcome. Thank you for being here. Appreciate you participating. I realize, especially for some of you, that this is late at night. So I thank you for being here and being part of it. I hope that as we go through things tonight that you'll chime in on the chat box if you have any questions or concerns, and we can address those as we go. We've got a lot of material to cover, a couple different chapters from the Series 7 preparation guide, so we'll try to get through some of that material. We also need to give a brief review of last week's coursework and a brief introduction to this week's coursework. Make sure that you feel comfortable and confident about this week's, what you've got on the to-do list. And then we need to spend a little bit of time at the end of class going over the exam for this week. So last week, it's a good segue into kind of our review of last week. Last week, we didn't go over the topics of the exam other than to say that the outline, right, was what was going to be tested over. And overall, I was very impressed with how well everyone did. So if you didn't do as well, just know that it might have been because you didn't know where to look or what resources to use. But if you just looked at that outline and followed that outline, I think the exam turned out very well for a lot of you. So good work. Great. I'm glad to hear that. We want it to be easy. The biggest issue is knowing where to find the information, right? So as far as the assessment this week, the definitions, which are a link to on the week 2 readings, will be the primary driver for the material on the test this week. I will be going over what you need to know for the test, Michelle, but a new link this week, not the outline. The outline still can help. You can maybe use that, but there's a PDF on week 2 that is the definition of terms. And that's what you'll want to primarily reference for this week's test, okay? There are 35 questions on the test this week, and that's a little bit of a misleading thing because there's actually like 50 questions, but a few of the questions are multiple. They're the matching questions, and although they're only one question technically, they're worth a lot more points because you've got a lot of matching as far as terms and definitions. So Michelle, I gave one answer last week. I may be, we'll see what mood I'm in by the end of class. I'm probably not going to give you any answers this week. Probably what we'll do is go through what topics you need to know, and make sure that you understand which topics you need to know, because last week turned out to be much better scores than I expected for the test. So we definitely don't need to give free answers if we're doing very well on those tests, right? But good try. The rest of the class is very appreciative of you trying to negotiate for more free answers this week. Hey, welcome, Sabrina. Okay, so we have a few things, like I say, to cover as far as review from last week. I mentioned the test. Test went very well. If you still haven't taken it, make sure and get in there and get it done. I mentioned on an announcement today that everything's graded. If you turn it in on time, everything's been graded. It was graded as of last night. So you should have some feedback on everything that you did and turned it on time, as well as a score. If anything's not been graded and you turned it in on time, please zip me an email right away so that we can catch that and get you the points that you should have. All right, so a couple common things from last week as far as the discussion board is concerned. A handful of you just, missed a few posts, missed a post, had one post instead of 2 or 3. A few of you didn't get a post in by Wednesday, and a few of you didn't get 3 posts in by Saturday. And a few of you didn't have 2 different days of participation on the board. Okay, so those are all expectations, minimum expectations for full credit. Just keep all those in mind for these future weeks so that we can give you full credit for the discussion board, which is, as I mentioned last week, one of the easiest ways to get points along with checkpoints each week. So we've talked about the assessment, we talked about the discussion board, the assignment. I was a little bit discouraged because we only had about half the class. We got 27 students. We only had about just over half the class turn in the assignment from last week, which makes me think that people started looking at it Saturday night and just didn't know how to start or get going, and so they gave up and just didn't do it because it didn't look straightforward or didn't look easy. I'm hoping that people will review the session, review the material, review the instructions, give themselves a little bit more time, and that we'll see more of those assignments come in. As I mentioned last week, you've got until the end of the class, right, to turn in assignments. You're not going to get full credit, but you'll get most of the credit. So I strongly encourage you to get those in because they're worth so many points. Each one of those assignments is worth more than a letter grade, right? So we want to make sure that we get all those assignments in and can get credit on them. Now, those of you who did turn in the assignment, most of you got full points or near full points on the assignment. So I feel very good about, the ones that I did grade. I just am missing a lot more than I'd like to. Most of you did the assessment. Most of you did the discussion board, but there's a handful of you that still need to get the assignment in. All right. So having said all that, any questions from last week before we start talking about this week and the material for this upcoming week that you're in the midst of? Concerns, questions, problems from last week? Salinas, the test went well for you. Did everybody else feel okay about the test? You don't obviously have to give a lot of information, but I'm, based on the average score, I think most everybody did very well. Good. Good to hear, Jack. Okay, so for this week, as I mentioned, we'll spend a few minutes at the end of class talking about the test for this week, so we're not going to spend time now in great detail, although I've already introduced the fact that you've got matching questions, you've got multiple choice, and you've got true false for this week. 35 questions, but there's more to it than just 35 questions. So give yourself a little bit more time than you did last week. It's not a midterm as far as covering the material from last week, but it is a midterm in the sense that it's a longer test and worth more points. Okay? So we will cover the topics that you need to know once we get to the end of class tonight, about the last 10 minutes. As far as the assignment this week, you've got a 3-page paper, okay, a 3-page paper, APA format, similar to last week's formatting. This week, you're going to be writing about regulation, and that's the topic kind of for this week and for tonight is regulation, regulators and regulations. So the instructions give you a lot of material. They talk about, the Securities and Exchange Act of 1934, Securities and Exchange Act of 1944, I think, or 48, I don't know what it is. Anyway, there are 2 different acts that they'll give you some feedback on and that you'll want to basically understand what those acts had. Then, one of the, I think, more interesting parts of this week's assignment is that you need to do some research and find some cases of fraud that you can talk about as far as ones that the SEC has gotten involved and maybe people have ended up in jail or that a lawsuit is pending. Now, in the past when I have this assignment, most people, they Google search, securities fraud or investment fraud, and the first thing that shows up, of course, is Bernie Madoff. And you're welcome to write about Bernie Madoff. I would encourage you to not write about Bernie Madoff because I get to read 27 papers, and if they're all about Bernie Madoff, that's not very interesting. I would love for you to research somebody, a fraudster, as far as investment fraud, in your state, okay? So whichever state you live in, just do a Google search for investment fraud and then Utah, or investment fraud New York, or investment fraud California, and you'll find plenty of opportunities to write about, plenty of different people who have had some kind of investment fraud in recent history that you can talk about. The links are provided as far as the Securities and Exchange Acts and the different laws and regulations. The securities are not provided as far as your state-specific fraud, right, that we're just talking about, Michelle. So I'd like you to do some searching and find fraud that's specific to your state as it pertains to investment fraud specifically, not any kind of fraud, right, but investment fraud. Okay? So that's this week's assignment. Like I say, should be really easy to fill 3 pages, with material based on finding, some fraud information in your state, and then also the other articles about regulation that are already provided you. Okay. All right. Any questions, concerns for this week's assignment? Okay. This week's discussion board is kind of in a similar vein. We're talking about regulation on the discussion board as well this week. We're talking about some recent laws that have been enacted, like Dodd-Frank, and we're also talking about a little bit about what role regulation has. One of the things that many people will say when it comes to regulation is, if they're on the far right, they'll say less regulation is good, right? We need to let free markets do their thing. And then you'll have people on the other side of the political aisle that will say more regulation is good because we've got to protect everyone, right? We've got to try to protect people from the problems that are out there, the pitfalls that can potentially take people's money. And both sides, okay, before we get arguing both sides, right, on the discussion board, both sides have merit, right? So it's not, like almost everything else in politics, and this is why it's so frustrating that we're, so inept at this point and can't get anything accomplished, because reality is most of us agree on most everything. There's just a few points that we end up getting, taking sides on, and then we allow those sides that we take to polarize us on everything else, every other issue, right? So anyway, now that I'm off my soapbox about politics, when it comes to regulation, it's a similar thing. Most of us want some regulation. Most of us don't want too much regulation. And especially if it costs money, right, to do it, costs taxpayer dollars to do regulation, we want to limit it to the amount that will protect the most people and do the most good, okay? So before we take sides and say no regulation is great or significant regulation is great, reality is most of us are going to be somewhere in between. You can argue or give your viewpoint on one way or the other. I'm not saying you can't. I'm just saying that, instead of polarizing the discussion board by saying there shouldn't be any regulation or there should be a ton of regulation, make sure you've thought through it, make sure you've done some research, and make sure you have good reasoning as to why, as opposed to just taking a side. Okay? So as always, the discussion board is more about your opinions and less about the information and research you find, although the information and research is also helpful, of course, to the board. Okay? All right, so make sure everybody to get your main post in by Wednesday at midnight. Make sure you've got 2 different days of participation on the board and at least 3 posts by the end of the week, 2 response posts, 1 main post. And that main post, most of you did a great job on. A few of you didn't get references and didn't get 2 to 3 paragraphs. So make sure we've got a pretty substantive post with references for that main post so I can give you full credit. Okay? All right, any questions or concerns on the discussion board this week before we continue? All right, everybody's just doing great. Okay, so a couple things that we want to talk about. Last week, we talked about how the NASD, okay, the National Association of Security Dealers, was disbanded, and now we have what's referred to as FINRA, right? FINRA, which is an acronym for like Financial and Investments something 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 association, okay? And FINRA is a self-regulatory body, meaning that it's industry professionals that are regulating themselves, which sounds like a train wreck, right? But they answer to and are definitely beholden to a very powerful government agency called the Securities and Exchange. Okay, and the Securities and Exchange Commission has significant power and significant ability to put people in jail or fine them for violating rules and laws. Okay. However, as a government agency, they're restricted on how much resources, okay, how many resources can be put there, right? So they can't have enough people all over the country waiting for somebody or preventing people, everybody everywhere from from executing investment fraud. So they rely heavily on FINRA, okay, the self-regulatory body, to help them monitor, regulate, and develop law for the investment world. Okay, so FINRA is more of the ground game, right? And the SEC is more of the head, they're in charge, right? They're the power behind it. Okay, so everybody feel okay with the SEC versus FINRA? Because both those are going to come up later in our discussion tonight, and also as you look at the information, and the topics that we cover, but also throughout the course, it'll come up on the test. You'll see FINRA, you'll see SEC. It's good to know what we're talking about. Good. Okay, so that's as a background. Now, most of what the Series 7 exam is testing about are the rules and issues associated with being an investment advisor, right? So who created most of those rules and most of that content? FINRA did. Okay, the SEC does like I say, a lot of the discipline, does a lot of the high-level rules and laws, where FINRA is the ground game once again. They're the ones developing a lot of this material and content for the Series 7. What I would say is that FINRA is more interested in developing best practices, and the SEC is more interested in developing the hard and fast laws and penalties for violating those laws. Okay. All right. So in a business like investments where there's a lot of gray area associated with the law and what's right and what's wrong and what's ethically right and what's ethically wrong, FINRA does a lot of work, establishing right and wrong and establishing, an ethical threshold, right? An ethical barrier for folks who are in the business. All right. So let's start talking about some of these slides. So the very first and one of the most important things in interacting with a customer when it comes to investments is understanding a customer's objectives, okay, and their needs. And this seems pretty intuitive, right? But just in case none of us or some of us have never invested before or have never done any kind of financial planning, I'm just going to compare it to going to go buy a car again. Okay, I think we talked about buying cars last week as well. That's something that most of us have done at least once in our lives, right? And Salinas, Michelle, Jack, Sabrina, good experiences or bad experiences buying cars? Do any of you want to share? Good, bad? Jack, you've had both. Most of us have had, yeah, I would say that most of us have had both good and bad, depending on our situation. Well, Salinas, you don't have to worry about good or bad situations with cars. I think some people would say that's a good thing. You don't have to hassle with that. So we've all had good experiences and then we've had bad experiences. Let me just throw something out and then let's see if you agree. When I have had a bad experience at a dealership or at a used or new dealerships, it's usually because I feel like the salesperson does not care about me at all, does not listen to what I'm telling them that I want, does not care at all what is in my best interest, and is just ramrodding a sale down my throat. Is just really, really trying to push me to buy. Okay, so that's the bad experience usually. When I have a bad experience, that's what happens. When I've had a good experience, I feel like it's a low pressure situation that is very informative. Okay, that somebody offers a lot of information and help, gives me some guidance as far as the information, because they're the ones that are in the business, right? And they can give me some perspective and guidance. And then I feel like the salesperson is more interested in trying to help me with what I want as opposed to what they want, which is just getting the sale. Okay. So anyway, that's my description of kind of the good and the bad. Sabrina, it sounds like sounds like you got taken at one point with a bad situation. But once again, that kind of matches the theme that I just mentioned, which is the salesperson wasn't interested in you and really helping you. They were interested in just trying to make a sale, right? And of course the salesperson is interested in making a sale. Maybe that's a little bit oversimplistic because they're all motivated by making sales, right? That's the business that they're in. However, some of them do a very good job adding value, being informative, being a good guide as opposed to a high pressure, pushy, salesy type person. Okay. Now, I don't know if that's the same for the rest of you who mentioned that you'd had both experiences, but for me, that defines the difference between a good experience and a bad experience at buying a car. The same concept is true for investments. Okay, the same concept is true for investments. Sabrina had a bad experience at 18. Michelle, I think you're right. Unfortunately, that there's still some sexism that occurs when it comes to auto purchasing. Yeah. So it is good sometimes to take other people so that you don't get pushed around. But the same concept is true for investing and for financial planning. One of the most important things that should be happening between you and an investment person, so if you go and interview somebody to potentially invest with them as an advisor or do some financial planning or buy insurance or whatever it may be financially, their primary goal initially should always be to try to understand what your needs and objectives and goals are. If they don't go down that road, then you should not employ them. Don't work with somebody who's not interested in truly finding out what your needs, objectives, and goals are. And in fact, know that FINRA and the SEC require the know your customer, okay, the know your customer suitability to happen. Okay, so it not only is it best practice, but it's also the law, right? Financial advisors, anybody advising us with financial products, should always assess whether or not whatever they're selling us is suitable, and the only way they can do that is if they find out our needs and objectives at the beginning. Okay. Now, having said that, many customers kind of push through that, right? They don't want to back up and talk about needs and objectives and goals. They just want a product, right? They'll come in and say, I just want some basic life insurance, or I just want to invest in GE stock or Disney stock. Okay. And they're kind of impatient with, you know, the process of trying to find out more information that if a good advisor is trying to do that. And what I would say to that is, we as the consumers or customers need to also understand that legally a good advisor has to go through that process of getting to know us better before they can give us good advice, or before they should be even giving us any advice. So even if we're the ones that are a little bit impatient and just think we already know what we want, we should still allow for this process of fact-finding and suitability to occur, because that's legally what needs to happen, both to protect the advisor and to protect the customer. Okay? So that's the investment relationship that should happen. Is, as a consumer, we should be patient with the advisor asking us questions, and as an advisor, we should expect of our advisors that they will go through a series of questions to really find out what we're trying to accomplish, what we're trying to do, and then, and only then, after they had an ability to assess what's going on, then they can offer us good advice and good information. Okay? Now, when I say they need to ask questions and they need to assess our suitability, what kinds of questions do you think would be helpful being asked by an advisor to assess whether or not the types of products that they're advising us are suitable? So can you think of any questions that might be good questions for an investment advisor to ask us as a customer before trying to sell us something, before offering products? Yeah, what are you trying to accomplish, right? What's your goal? Good, Jack, that's a good start. What if the person says, I have no idea what my goals are, I'm just trying to grow my money? Well, Jack, in that case, that's your goal, right? You're just trying to grow your money. You're trying to get something that will grow your investment over time. What are your goals? Are you trying to create income, or are you trying to get something that will grow over time? What's your time frame, right? How long can you invest? Is it really short term? We might have to be more conservative. Is it really long term? If it's really long term, right, we can potentially be more aggressive. What's your price range? Good. Michelle, great question. What are you willing to pay? What are you willing to pay for your investments or for your advice? Because some people think that advice and investment advice, especially in financial planning, should be free. Well, if I have a client tell me, you know, I'm not willing to pay anything, you should be doing this for free, my response is, I don't work for free. I work to make a living and feed my family, so you're going to have to find somebody else that says they work for free. And good luck with that. And if you do find somebody that says they work for free, I'd run, because they're lying, right? And they're just taking advantage of you. Great question. What risks are you willing to take? Excellent question, Sabrina. What are you willing to take? When somebody looks at investment products, they should always be able to describe to me how much they're willing to watch their account go down. Let me give you an example of this. Ever since 2008, when I look at a portfolio for somebody or do some kind of investment advice for somebody, I will say, this is what this portfolio did in 2008. Are you okay with that? And invariably or inevitably, the response is, whoa, I didn't realize it would lose that much because 2008 was so bad, right? But then I say, but your average over the past 10 years is this. You've been able to average 7 or 8% returns, even with how bad 2008 was. So if you're patient, it's okay to have, decreases like 2008. But if you feel like you would get out of this investment if we had another 2008, and if you went down by 20 or 30 or 40 or 50%, then we shouldn't do this investment, right? So it's a way for me to assess people's willingness to take risk by giving them 2008 as an example, which very well might happen again, right? If I give them that as an example, it allows them to decide how much risk they're willing to take. Because a lot of people, unfortunately, Sabrina, just have no clue, right? They're just like, well, I think I'm pretty conservative, or I think I'm pretty aggressive, or I don't know, I think I'm kind of moderate, in between. I'm not really aggressive, I'm not really conservative. Some people will say something like that, right? But they don't really know what that means, because even a conservative customer in an investment portfolio in 2008 lost 15 to 20%. And I tell that to some people that think that they're conservative, and they say, whoa, I'm more than conservative then. I don't want even a chance of losing my money. And if that's the case, then we can't invest, right? Because investments always have risk associated with them, and we've got to be able to assess that. So that's a great question. Now, I tell people, and we talk about with most people that we're looking at investments with, I will tell them time frame is the most critical element of assessing suitability. Time frame is the most critical element of assessing suitability. Why? Because investments, depending on their risk, okay, conservative ones can have lower time frames, smaller time frames, shorter time frames. Aggressive ones can very well have longer time frames, but you don't want aggressive investments that are short term, and you probably don't want really ultra conservative investments for the long term. Why? Because they're not going to provide you a good risk return, for how long term you are. Okay, so time frame is critical. If you've got a long time, you can be more aggressive. Doesn't mean you have to be, but you can be more aggressive. If you've got a short period of time, you should not be aggressive. You should be more conservative. Okay, so time frame is a key piece on establishing somebody's suitability. What is suitable for them to invest in. And the SEC and FINRA actually require that investment advisors who are registered notate that they've assessed suitability. So we've talked about how not only is it a best practice, but legally, it's the law. As an investment advisor, you have to find out suitability, you have to find out time frame. Now, having been in the business for 13 years of investing, I will tell you that I have a lot of colleagues and friends and people in my business who fill in that information on behalf of their customer and don't truly go through that exercise with their customer. Okay, so just be aware that that happens. And if you are meeting with somebody who does that, where they just give you an investment product and they don't ever really go through risk and time frame and try to establish suitability with you by asking you a series of questions, once again, I think you should leave that meeting, leave that interview, and go interview somebody else that will do that. Okay. Okay. Is everybody still able to see the profile of a customer screen? Investment profile of a customer? Just want to make sure that's still on the screen as we speak. Okay. One more quick thing. This slide refers to non-financial information. So we talked about time frame, we talked about goals. Some of those are non-financial, right? You might have a goal to go, live in Honduras for retirement. And really, it's not really a financial goal as much as it is just that's what you want to do, right? That's an aspiration that you have. Or you might have a goal to, to be able to do something specific with your children and grandchildren over the next 20 or 30 years. And it's not, it in the end becomes financial, right? But the goal itself is not necessarily a financial goal or even financial related initially. It's just a goal that you have. And some of those goals are very important for a financial advisor to understand. right? What your plans are in retirement, financial and non-financial. What your plans are as far as when to retire, okay? What your plans are as far as, how long you're going to work and what you're going to do over the, whether or not you plan on staying at the same employer or whether or not you plan on changing. Those aren't necessarily dollar sign questions, but they do become relevant to an advisor trying to give suitable advice, trying to give good advice and get you the right products. Okay, so sometimes as an advisor, I'll be asking people questions, and I'll get to a question that I ask, and they'll say, do you really need to know that? They'll say something to that effect, and I'll say, yeah, actually, I need to know all this information. I wouldn't just be randomly asking you questions because I'm curious. All these questions have a point and a purpose. I need to paint a clear picture for myself of what your situation is so that I make sure that I get you the very best products and very best, planning possible. And if we can't go through that process of fact finding, like I say, I'll encourage people to go find somebody else to work with, because I have to be able to do that in order to document, in order, that I did that, first of all, as a base level, but also, and perhaps more importantly, to give those people the best advice that I can, right? I've got to feel like I really understand and know that person before I can give them good advice, okay? One more consideration that some people don't think about is investment experience. And does anybody want to take a stab at why investment experience would be important to understand about a person as far as assessing their suitability, what products to offer them? What would investment experience have to do with what we should invest in? Anybody have any ideas? Let me ask you this. What would be the difference between somebody who's invested over the last 30 years in the stock market versus somebody who has never invested in the stock market? Do you think that the person who's invested for 30 years probably has maybe the ability to take more risk or less risk? Any guesses? Bueller? Anybody on? Yeah. So Michelle, it stands to reason that somebody who has a lot more experience, now they might not choose to take more risk, right? They could still be very conservative. That's not the issue. But it may be suitable for somebody with some investing experience to take more risk than somebody who has no investing experience. When I meet with somebody at the bank who has only ever put their money in CDs or a savings account and they've never invested in the stock market or in bonds or any kind of market-related products, I have to be very, very careful, because when you invest in the market for the very first time and you've never done it before and you've never done anything even like it before, it can whip you around like a rag doll. It can eat you up and spit you out because of how fast it moves up and down, right? So sometimes that experience, that investing experience, plays a big role into how aggressive or conservative somebody needs to be. Yeah, it's exactly right, Sabrina. It's actually the reason why a lot of investment advisors and folks who are in the investment business are very aggressive with their investments, because they're willing to watch it go up and down. They know that's just what happens. They've seen it happen multiple times, and they know long term, though, they'll be in good shape. Where if you've never invested before and watch your investments go down by 20 or 30 or 40%, you're unlikely to think that you're going to be okay, right? Usually what you're thinking when things go down by 5 or 10 or 20 or 30% is the world is ending. I'm going to lose all my money. I can't risk all this money. I'm going to take it out, right? And then you do the worst thing that you possibly can do with investing, which is to pull out of your investments right when it's down, right? Because we know it's going to go up and down, but the downs are temporary and the trajectory is good. So if you hold on during those downs, you're just fine. If you don't hold on during those downs, you lose your money. And that's why if somebody doesn't have the investment experience or knowledge, at least, to understand that concept of the market moving up and down, they might not be right for them. Or they might need to just ease into it or do something small initially. There are all kinds of ways to kind of get your feet wet, and dip your toe in the deep end before you jump in, right? And I'm definitely interested as an advisor in people getting a feel for this, whole stock market investing thing before they just jump in with both feet, because that can hurt you. Yeah, so Sabrina, good point. We always hear about buying low and selling high, right? We want to buy when pricing is low and sell when pricing is high, because that's how we make the most money. It's like anything else in life that we buy or sell. If the car was 20% less than the day before, we'd feel like we were getting a good deal, right? We'd pay a lower price. And we might be able to turn around a year later and sell our car and actually make some money, if we got a good enough deal on it. That's what used car dealers do, right? They buy low and sell high. That's what they do all day long. That's how they make their money. Investment traders, that's what they're trying to do as well. Investors, long-term investors, are trying to buy over time something that will appreciate in value over the long run, right? And so they definitely don't want to be selling out every time it goes down in price. They want to do exactly the opposite, like you just said, Sabrina. So right now, for example, Apple stock over the last year is down 25%. You have two different camps of people right now. You have people who are panicking because Apple stock is down 25% and they're just selling out of all their stock. And then you have people that are coming to me and saying, with Apple down 25%, still a great company, I think I want to buy some. And in the end, okay, and it might be 5 years, it might be 10 years from now, it might be 6 months from now, the person who buys when things are down turns out to be the winner. Okay, the person who sells when things are down is a permanent loser, right? They're selling out after they've lost money, and they'll never be able to get that back from that particular investment. They need to show a little bit more patience and let it come back before they sell. Okay. The other side is true though too. When things get really good, that's a time when we need to potentially consider selling, right, and taking some of our profits. So there's both sides to it. Both the buying low and the selling high that has to happen to really be successful as a long-term investor. Okay. Good discussion there. So what are some different objectives that people can have? Some different objectives might be, I need current income, right? If somebody's in retirement and they just want to get some income, they want current income. That's their investment objective. Or somebody might be like me. I'm going to be turning 36 years old this year, and I don't need income right now. What I need is long-term growth, right? I want my money to grow as fast as I can over the next 20 or 30 years until I get to retirement so that I'll have something for retirement. So my investment objective is growth. You have people that have investment objectives to grow and get income at the same time, kind of a balanced approach. You also have people that are just in the business of what's called capital preservation. What is capital preservation? It's exactly what it sounds like. You're just trying to hold on to your money and not lose it. So what would you do if your objective was capital preservation? You stick your money in a bank account like a CD or savings account where it has no risk of going up and down and just collect your interest. Okay. If I want something that's growth oriented, the market is great for that. If I want something that's income oriented, rental real estate's great. Bonds are great. There's a lot of different options in all those different categories. Okay. So those are some objectives, and that's how we approach products based on those objectives. So the first thing we want to know about is risk profile and suitability, and the second thing is, really clarify and iron out what their objectives, their true objectives are. And sometimes you have to help, advisors have to help coach a client on what those objectives should be, right? A lot of customers and clients don't know the terminology, the investment terminology, but they do know what they want, right? And maybe it's, hey, in 20 years, I just want to retire comfortably. Well, what that means to me as an advisor is you've got an investment objective of trying to grow, right? Trying to invest for growth over the next 20 years. And then in 20 years from now, we'll convert that investment objective from growth to then more of an income objective so that we can take care of you in retirement. Okay. That's what we wanted to cover from Chapter 2 as far as just suitability. Suitability is huge. And if you leave with nothing else tonight, I just want to make sure that you all understand that as a consumer or customer of investment products or financial planning or any kind of financial products, I want you to be an informed consumer, and I want you to make sure and hold whoever's trying to give you advice accountable to the law, which is to make sure that whatever they give you as far as advice is suitable. And the only way they can do that, the only way they can, make sure that what they're giving you is suitable is by asking you enough questions to feel like they truly understand what you're trying to accomplish, okay? And they can truly put your objectives first as opposed to, what they're just trying to sell, okay? All right, that's it on that one. So then there's an obligation after you've assessed as an investment advisor suitability, right? We've talked about that. Then you're going to turn from a question gathering, an information gathering phase, okay, and you're going to convert into an education giver phase. Okay, you're going to present different products and solutions and ideas, and it's so critical in this phase that you treat it like you're a teacher or educator or coach, meaning you need to be able to educate people so that not so that they understand everything. That's not the point. They don't need class after class after class with you about trying to understand all this, but they do need to understand enough that they feel comfortable and confident with what they're doing. And when it comes to their money, we've got to be very careful that people feel very comfortable, okay? Because the market, the ups and downs of investing will make somebody feel uncomfortable no matter what. But if you tack on top of that they don't understand what they have or why they have it, then it becomes overwhelming. They lose sleep. They sell out at the wrong times. They make poor decisions. So we need to take the role, or an advisor needs to take the role, if we're the consumer or customer, as an educator, as somebody who informs and educates us. I mentioned that in terms of the car dealership, right? You recall that I mentioned my good experiences have to do with somebody finding out what I want, really listening to me, and then trying to educate, inform, and guide me on different solutions that are truly a fit for what I'm trying to do. The same is true for investing. When they get to the product part, instead of just focusing on all the bells and whistles, all the exciting parts, right? Which an advisor can still do that, but instead of only focusing on that, they need to talk about all the pros and cons of the solution, right? So the risks associated with the solution. The potential rewards are part of the discussion, but they also need to talk about the risks and potential downsides to doing whatever kind of investment that they're looking at. So another rule of thumb when working with investment advisors or anybody who's selling you some kind of financial product, first step, we want to make sure that they're assessing suitability, assessing our needs, our objectives, and really listening to what it is we're trying to accomplish, and then giving us solutions that show that they have our best interest at heart. But then when they come back with solutions, we need to be working with somebody that's willing to take the time and make the effort to help educate and inform our decision making. Okay? So instead of just giving us one solution, saying it's the best thing in the world, talking only about the pros, the advantages, and then just selling, pushing the hard sale like a car salesperson, we need somebody who's willing to educate us on options, okay? Options that we have, and then still give us advice and guidance on which option they would prefer for us and why, but then allow the choice to be ours, right? Because we should always maintain the choice, or an element of choice. And even if we end up taking their advice, we still should have had a choice and been educated and guided on the different solutions that are available. Okay? All right. So it can be a very good process. Having said that, if I were to say advisors all act like this, I'd be lying. I know in my 13 years in this business that there are a lot of advisors who don't assess suitability the way they should, who don't educate their customers and clients and give guidance and good solutions and options. And so that's why I am telling you all to make sure that when you engage someone with financial planning or any kind of financial product, insurance, investments, or otherwise, that you find somebody that's willing to take the time and go through this process of really accomplishing the right products and services for you and your situation. Okay? All right, so when we get to the education part, we have to make sure that we're sufficiently covering or adequately covering the issue of risks. Have any of you invested in mutual funds before? Selena's, Michelle, Jack, Sabrina, any of you guys invested in mutual funds through like a 401k or an IRA, any kind of work retirement plan or anything like that? Okay. All right. So I'm sure there's a handful of people in the class that have at some point. Most of the time it's just through like, you work at like Walmart, for example, and you have a 401k through Merrill Lynch, and Merrill Lynch puts your money in some different mutual funds, okay? So Jack, yeah, you've probably got a few mutual funds inside of your 401k. Now, if you were to go inside of your 401k and, look at your holdings, your investment holdings, they would give you the opportunity to get what's called a prospectus. Okay, a prospectus. And the prospectus for a mutual fund is about a 30 to 60 page document, okay, booklet. And most of that booklet is addressing risks, potential risks associated with the mutual fund that you have. And in my experience, if somebody actually reads that prospectus cover to cover, they'll be scared to death, because it's some legal team somewhere has spent lots and lots of time coming up with any potential possible risk that could happen with your mutual fund or with your account. And I tell you this because not because you need to address every single risk in detail like a prospectus does. By law, you have to provide somebody a prospectus when you sell them a mutual fund. So they're going to have a copy of it. They can review it themselves. But it is important as an investment advisor and as a consumer or customer of investments that you understand the main risks, that you understand the main things that could go wrong with your investments. So let's take, for example, a mutual fund. Okay, let's say we're going to do a mutual fund that invests in the stock market. So it invests in the S&P 500, lots of different companies in the stock market. Okay, and it's a mutual fund, so it's got 500 companies inside. One of the main risks associated with that mutual fund will be fluctuation risk. What do I mean by that? Well, next month you could be up 5%, and the month after that you could be down 10%. We know that that investment will fluctuate, and at times will fluctuate quite dramatically. The good news is that it's going to fluctuate, at least historically, more to the upside than it will fluctuate to the downside. Okay, statistically over the last 80 years, about 3 out of 10 years are down, and about 7 out of 10 years are up. So the odds are that if history continues to play out, that most of the time, 70% or more of the time, your mutual fund that's in stocks will go up. But a very important risk to understand before you get into that mutual fund is that 3 out of 10 years, or about a third of the time, you go down. Okay, your value will actually go down, and it'll be lower than what you had when you started the year. So, what is this? What's important about this risk? Well, you know before you invest in that type of product that's going to fluctuate, and sometimes that it fluctuates very dramatically, and that's a very important risk to make sure that you understand before you get into a product. Any product when it comes to investing. How much will it fluctuate? Okay. Now, there's all kinds of other potential risks. Potential risk of some world-ending event, potential risk of some kind of terrorism or recession that creates, pressure on the markets and then lowers your account. There's risks of each one of those companies inside of your account going bankrupt. Okay. Not all the companies at once, but, 1 or 2 of the companies in any given year could go bankrupt, and then you lose some value that way. So those are the main risks, though, fluctuation risk being by far the biggest issue. But there are other small risks that are worth just mentioning. And it's very important to cover those types of risks in detail. And maybe even more detail and more, more time and effort should be put there than the risk of or the potential, of returns. Okay. Michelle, you should be on 3.1, investment risk. Where are you at? I've been through 4 or 5 slides at least. Is everybody still on slide 1? Ugh. So your slides aren't moving then. Yuck. No wonder you're not engaged. Nobody's seeing any slides move. Everything's just stuck. What is going on here? What about now? Any movement? You guys have to let me know before before we get to that point. I think we had the same thing happen last week. Sooner, you got to let me know sooner. All right, so we are going through slides here. Okay, so we went through investment considerations, objectives, suitability, We talked about objectives. This is just a blank slide that we talked about different objectives like income growth, growth and income preservation. Those are all important objectives. We talked about some key terms. Now we've been talking about risks. Okay, so that's the 3.1 that we've been talking about, and how, as an investment advisor, there's an obligation to educate and guide customers and clients through the different risks associated with what they're going to do. There's other things like taxation and terminology, and this week on the test, a lot of it's just basic investment terminology. Well, in a situation where you're either a customer of investments or an advisor of investments, either way, knowing the basic investment terminology would be helpful, right? Knowing it from a customer's end is great. It's like going to a car lot, and before you go there, do some research on the cars that you like, right? Know what you like, know what you want before you get there. Same thing is true for investing. And of course, we expect that our advisors understand and have a basic knowledge, and that's why they take this Series 7 exam or test that our material comes from, is because we want to make sure that those advisors have at least a basic level and understanding of the types of things that they're talking to us about and advising us. Okay? All right. Well, now that we finally got the slides working, class is almost over. I need to spend the rest of the time on the test, the assessment this week. And so we're done with slides now that they finally started moving for you. I apologize for that. Now that that's happened twice, though, right, Michelle, you've got to you gotta speak up a little sooner this next time. Come on now. All right. I don't know why it gets stuck like that every time for some reason, because I'm doing the exact same thing when I get back in and go back in and change it, but for some reason it gets stuck on that first slide like we did last week. Okay. All right. So number 1 on the test has like 12 parts. Okay. And before you start getting nervous about all these different parts, all it is definitions. Okay. So let me give you some examples for number 1. Number 1, you're going to be matching definitions with different terms. And some examples of different terms that will be on there are terms like arbitrage. So what is arbitrage? What are bonds? What's a broker-dealer? What's an initial public offering or IPO? What's margin? What's a mutual fund? What's a registered representative? What are stocks? Okay. So there's some examples of different terms that are on there. And if you refer to the PDF that I've already told you is going to be very important for this test, you'll be in great shape for those terms, right? Because all those terms will be part of that glossary of definitions. Okay. Number 2 on the test just asks about whether or not you can retake the Series 7 exam, and if so, if you fail the Series 7 exam, can you retake it? If you can retake it, how long do you have to wait before you can retake it again? Okay, so you'll want to know that before you get to the test. You'll want to know an equation for calculating simple interest. Simple interest. So how do you calculate simple interest over time? Okay. How do you calculate simple interest over time? So if I told you you have $100, you put it into a CD for the next year, and you get $50 in interest, how could you set up an equation to calculate the interest rate associated with that? Okay, just make sure you know that equation before you get to the test. Make sure you understand what the definition of interest is. What is the definition of interest when it comes to debt? Okay, so when we give our money to the bank pays us interest, right? Why do they pay us interest? For the right to use our money. Okay, because when we put our money in a savings account or checking account or CD at the bank, they're going to go lend it out and give it to somebody else, right? And make money off it. They're going to go take our money and make money off our money. It doesn't just sit in the bank. They actually take it and go lend it out, and they go make money off it. So because they're doing that, because we give them the right to do that by putting our money in the bank, they pay us interest. Okay, so we want to know what interest is. How do you define interest? Make sure you understand the concept of time value of money as it pertains to dollars. And when we talk about the concept of time value of money, just remember, for the purposes of the test, that a dollar today is more valuable than a dollar in a year. And why is that the case? Because I can take a dollar today and grow it over the next year, right? So in order for those to be comparable, the dollar in a year would have to be worth more. But if we're only going to give you a dollar today or a dollar in a year, of course you're going to take the dollar today, right? That's much better, because then I can go and put it to work and do something with it. So a dollar today is worth more than a dollar in a year or a dollar down the road because of the time value of money. Okay, so that's a concept you'll need to know for number 5 on the test. Excuse me, number 6 on the test. Number 7 on the test is another one of these matching questions. And it also has 12 matching terms with definitions. And I'll give you some examples. Capital, interest rate, credit, political, currency, and business. So these are not hard terms. So Michelle, before you get stressed out, these are not hard terms at all. In fact, I bet most of you would be able to get them all the matching right, without even going and finding the definitions. And the reason is not because you know all these terms, but through the process of elimination, right? Some of the definitions will fit and some of them won't. Okay, it'll be very obvious, for example, on number 8 on the test, which one we're talking about when we talk about interest rate, or which one we're talking about when we talk about business, right? Those are terms that you've already heard before, and you'll be just fine on them. Michelle, you're going to be great. You're going to do just fine on it. When you come back with an A on your test, I will say, I told you so. These are not hard questions. Okay. And like I say, you've got this reference to all the definitions in the Series 7 exam, of all the terms on the Series 7 exam, and you'll be just fine. If you get below, then you didn't give yourself enough time and put the effort into it, because if you do, you'll be in great shape. Okay, next. Let's see. The next one on the test talks about what the objectives are for growth stocks. Okay, what are the objectives of growth stocks? Well, of course, to grow, right? And usually, growth stocks are ones that are valued higher because they're expected to grow over time. So usually growth stocks have higher valuations, what's called valuations, or people are willing to pay more for a growth stock because they think that it's going to go up. So that's the concept for number 8 on the test that you'll need to know. Number 9 on the test is the definition of a defensive stock. So the opposite of a growth stock is a defensive stock. You want to understand what a defensive stock is, how it differs from a growth stock. You'll want to understand what types of income there are from a tax planning standpoint. And I'll give you one of them. One of the types of income from a tax planning standpoint is earned income. That's what you make from your day job, right? If I go in and get a W-2, I get a paycheck every week or every 2 weeks or every month. That's earned income. But there are 2 other types of income that are taxable income, okay? So we're not talking about what you would say to your friend, hey, I've got some extra income or something like that. That's not a tax term, right? That's just a term we use in conversation. You'll want to know the different terms for income as far as taxes are concerned, and you'll get number 10 on the test right. Okay, I think that's as many as I'm going to cover as far as topics, and basically giving you answers on some of those and how I described them. Let me just look through the rest, though. Looks like you're going to want to know a little bit about, where to find information on taxes, which Investopedia is the source on a lot of these. So use Investopedia to search for information. You're going to want to know definitions of equity, okay, for one of the questions. What is the definition of equity? You're going to want to know the definition of a descriptive share. A descriptive share. You're going to want to know the definition of share value. Share value. Okay. Here's another matching one on the test. Terms like stock certificate, limited liability, endorsement, escrow receipt. I mean, these might be terms that you haven't heard of before, but if you were looking at the answers or the definitions, you'd be able to match them up pretty well. And then you've got this glossary of definitions, which will just make it so simple. You'll be in great shape on those matching questions. Those will be the easiest ones on the test this week, are the matching questions. Another one of the matching ones that has cumulative, participating, convertible, and callable. Some different interest rate terms. Okay. You want to know the difference between LIFO and FIFO, which are accounting terms. FIFO is first in, first out. LIFO is last in, first out. Last in, first out, first in, first out. Okay, FIFO, LIFO, those are accounting terms. You want to know the difference between those two and definition of each. You'll want to know what an SRO is, self-regulatory organization. We talked about how FINRA is an SRO, right? Self-regulatory organization. You're going to want to know SEC Rule Regulation D, what that is, and SEC Rule 144. Okay, so SEC Rule Regulation D, just make sure you've got a note down, and SEC Rule 144. Okay. All right, we need to wrap up, but that's most of the material that you're going to need to know for the test. The fact that I've pre-given it to you as far as the information that you'll need on most of the questions will give you a huge head start when it comes to trying to prepare and study for it. But if it were me, okay, if it were me, last week I encouraged you to just review the outline, right? That outline of information for Series 7. This week, I would encourage you to just scan through. Don't read them all intently, but scan through the definitions, right? The glossary, the PDF with the glossary. Because what you'll find is that'll help you when you get to the test to go through it a little bit more quickly. Okay. All right. Any questions before we wrap up tonight? Concerns, questions? Okay. All righty. Have a good week this week. There are some true-false questions, Michelle. Yep. Multiple choice, true, false, and matching. All three. Okay, have a great evening, and let me know if you get stuck on anything this week, but good luck to you. I'm sure you'll do great. Michelle, you're going to be just fine on this test, but make sure you prepare and then have that glossary or those definitions close because they will come in handy. Okay, have a good week and have a good evening.